If you're an American living overseas, how do you structure investments to minimize double taxation? Well, first of all, if there's a tax treaty, then quite often this shouldn't be a problem. However, there are special accounts that sometimes don't appear in a tax treaty, aren't addressed in a tax treaty. For example, a Roth IRA account is quite often not mentioned in tax treaties. And then it may have different tax consequences. A Roth IRA, you're expecting for the money to come out tax-free, but in your country of residency, it may not be considered tax-free. Similarly, ISA accounts, UK ISA accounts work the same way in the sense that they're not tax-free for Americans because they're not recognized in the UK-US tax treaty. Wealth tax is another thing. This may lower your income, or if you lower your income, it could actually improve your wealth tax situation. And wealth tax is something we don't know anything about in the US. But in many countries, like Spain, for example, there is actually a tax on assets rather than just on income. So should expats hold assets in the USA, abroad, or both? Well, the nice thing about having your investments in the US, and this is what we always recommend, is that you get the 1099 tax reporting forms, you avoid issues such as PFICs, which are tax reporting issues on foreign mutual funds and ETFs. If you do want to hold money outside the US, it's best to hold it in cash products, such as savings accounts, for example. Or real estate is also a great investment. If you can invest in local real estate, that'll be in local currency. If it's rental real estate, it'll generate some income for you in your local currency. And the tax reporting obligations in the US are minimal. I mean, you have to report income from rental, but if it's not a rental property, it's pretty much minimal. Gold bullion, Bitcoin, more exotic things, they're also attractive investments for some people, depending on what your situation may be. Is it possible to open a non-US brokerage account? Well, you can do that. There are certain firms that offer non-US accounts, but they tend to have higher fees, and also you have to be aware of the investment protection in your country of residency. In the US, we have $500,000 SIPC protection, but that's not the case in many other parts of the world. For example, in Ireland, it's 20,000 euros, and in much of the EU, it's less than 100,000 euros. How do US expats diversify globally without triggering the PFIC rules we were talking about? Well, you can use US exchange-traded funds and ADRs to diversify globally. For example, you might have a US exchange-traded fund that invests in European stocks or bonds, and that, as long as it's not hedged back to the US dollar, it'll give you the currency exposure as well as the underlying investment exposure. ADRs are American depository receipts, which are shares of non-US companies that trade on the US exchanges, so easy to buy for US investors. You can also buy non-US shares, bonds, and invest in non-US cash products in the country in which you live. But for this, to buy non-US shares, you really need to go to a company like Interactive Brokers, which gives you access to many investment accounts, investment exchanges around the world. Typically from the US brokerage firms, it's not easy to invest on non-US exchanges. So what role does residency versus citizenship play in terms of taxation? Well, the US is only one of two countries that taxes on the basis of citizenship. The other one is Eritrea, so we're not in great company, really. And so an American can never escape the IRS. And because of that, you always have to file tax forms in the US if you're above a certain income threshold, as well as in your country of residency. So tax residency is generally established on the basis of how many days you are present in that other country. Usually, if you're there over 6 months, you're a tax resident. Sometimes it's based on domicile. Domicile being where do you have the closest ties? To which country do you have the closest ties? So it's important to know where you are a tax resident, and it's important to do certain things before you become a tax resident in a foreign country, like, for example, sell your US property. Residency may include global income taxation. So you may live in a country that looks at your global income, not just your income locally. But some countries, in fact, do just look at your local income, and it also depends on the type of visa you may have. So in some cases, like for example in Spain, there's something called the Beckham visa, where your non-local income may be excluded for a certain amount of time, and that's a great benefit you might have. I mean, generally speaking, Americans are subject to either U.S. taxes or the local taxes. You end up paying the higher tax rate. So what strategies may benefit U.S. expats in terms of tax strategies? So first of all, if you're dealing with something like wealth tax, quite often a wealth tax is a tax on assets rather than income. So for example, it exists in Spain. But not to get around that, but to mitigate that tax, it's also based on your income. So the government doesn't want you to have to sell your house in order to pay the tax, so they also limit it to your income. So there might be ways that you can mitigate your income because certain things don't qualify as income, such as capital gains. So you may be able to structure your investment portfolio to actually mitigate what they call income and therefore lower your exposure to wealth tax. The other thing you can do is shift assets to lower income categories. For example, in Spain, there are two types of taxation. There's tax on what they call savings, and then there's tax on what they call everything else. So savings would be something like a savings account or an individual or joint brokerage account, and that tax rate is much lower than income that, let's say, comes out of your retirement accounts in the US. So one strategy there might be that you take some money out of your US IRAs or Roth accounts, you put them into savings accounts, and then you'll be taxed at a lower rate if you're moving to Spain. And those kinds of tax issues are present in other countries. So that's one thing to look at. What kind of tax rate, depending on the type of income you have. And then in terms of estate planning, you may be able to mitigate your estate planning or inheritance tax issue by giving away some of your money before you actually move. Let's say you want your money to end up with your kids, or you want your house to end up in kids. So in France, for example, there's something they call usufruct, where you essentially have the use of your property, but you're able to gift it to your children ahead of time. So they own it, but you can use it until you die, essentially. So making gifts prior to the move and using the US estate tax exemptions might be to your benefit. Finally, and in some ways, most importantly, it's important to consult with an expert on these issues. Somebody who understands cross-border tax reporting issues, not just a US tax person in the States and then one locally, but somebody who understands a tax treaty. Similarly, on the estate planning side, somebody who understands how estate planning works across borders is very important. So then, what strategies help reduce currency risk in cross-border portfolios? Well, for example, it's easy enough to say, well, you can just hold your assets in that other currency. But you may not want to do that because of the problems with, for example, brokerage accounts and so on. You may have all your investments. You may have a lot in US retirement accounts that can't move, that kind of a thing. But you can directly or indirectly hold it in a local currency. So for example, you can invest in things like CDs or term deposits locally, or in the US accounts, you can buy exchange-traded funds that invest in non-US stocks or bonds, or you can buy ADRs, shares of foreign companies that list in the US. And then local investments such as rental real estate can also provide a local income for you. Suppose you have some kind of a major purchase coming up in a currency that's outside your currency of savings. Your savings in US dollars, you're buying a house in Europe. And some of these currency transfer services like Wise and MoneyCorp will allow you, through the use of forwards contracts, to lock in an exchange rate for a certain amount of time, typically 6 months or a year. So that way, at least you don't have to deal with the currency fluctuations and you can effectively fund your purchase ahead of time. How do you balance short-term liquidity needs with long-term global investments? So we always recommend that you have an emergency fund, whether you live in the US or abroad. 6 to 12 months of spending is usually a pretty good amount. And you want to have that in local currency, so you don't have to worry about the currency fluctuations, and you want to have it in something that's liquid like a savings account. You may not get a lot of interest on it, but at least you know that money is going to be there if you need it. And then longer term, we can structure things such as bond ladders for you. Bond ladders is, let's say you buy a 6-month bond and a 12-month bond and a 2-year bond, and then that amount of money will basically become available to you at different periods of time, and you can spend it. And so that also is a form of liquid cash that becomes available when you need it. And then finally, it's important to invest in publicly traded markets. If you have your investments locked up in insurance products or in private equity, well, that's not going to be liquid. Real estate, great investment, but not liquid. So apart from the emergency fund, the next step is to have money invested in something that you can readily sell if you have to sell it. And then finally, investment accounts that are linked to bank accounts. How do you move money back and forth? Because if you want to have this money available to you, but it's in a U.S. investment account, well, you also need to be able to move it to your local bank account when you need to. So you can link those accounts sometimes, or at least make sure that you'll be able to wire that money out in whatever currency you want when you want to do it. What about golden visas? What considerations are there around those? Some Americans use a golden visa program in places like Spain or Greece or many other places. And a golden visa is basically a way to ultimately maybe even get citizenship, but to at least have the right to live in that country for an extended period of time. That's what a golden visa is. They call it a golden visa because you don't actually have to be a resident in that country to get the visa. So a traditional visa would be you move there, it's a retirement visa, you live there. A golden visa can sometimes be acquired even when you don't live there, in preparation for maybe spending some time in that other country. And so how do you acquire these golden visas? Sometimes it's by purchasing property of a certain amount. A lot of those visas are going away now, especially in Europe, because that has driven up property prices for the local residents. Sometimes it's by investment. But you have to be careful if you're acquiring a golden visa by investment, because you are limited to certain funds that typically invest in the local economy. And sometimes those can be illiquid investments. They can be opaque in the sense that it's hard to tell what you're really investing in. And as well, they can even generate tax reporting issues for you. They could be what are called PFICs underneath US tax laws. So what are some of the common mistakes that expats make with respect to cross-border wealth planning? Probably one of the biggest ones we see is waiting to sell your home until you move and become a tax resident in that other country. You want to typically sell your U.S. home before you become a tax resident in your new country. Secondly, investing in real estate without local market knowledge. There are a number of advisors selling foreign real estate that make it sound like a good deal, and sometimes it is, but always go and check out the product and the neighborhood that you're investing in. Then, complex structures designed to mitigate taxation, insurance products, some kind of wrappers that you wrap your investments in, and they're designed to avoid local taxation. Be very careful what you're getting yourself into there, because you may not be able to get your money out, it may not be liquid, and again, it may be considered a PFIC under US tax law. And then, I already mentioned using banks to move money between currencies. The banks will generally give you a lousy exchange rate, so you want to use currency transfer services like Wise or MoneyCorp. And then if you're only dealing with advisors that understand a U.S. perspective, or only dealing with advisors that understand a local perspective, that's really not going to help you that much. You need to deal with advisors, tax people, investment managers, estate planning attorneys that understand the cross-border perspective and sometimes the treaties, like tax treaties, that govern these kinds of relationships.